How to build an all-weather portfolio when investing. An all-weather portfolio aims to perform consistently across various economic scenarios, balancing growth potential with risk mitigation. The key to its construction is diversification across different asset classes, which can respond differently to the same economic conditions. The goal isn't to have the best returns, but the most consistent returns with a mix of low correlated asset classes that don't jive together. Here's an overview of the assets typically found in an all-weather portfolio. U.S. bonds. Regarded as a safe haven asset, U.S. bonds can offer stability during market turmoil. For example, the Dalio all-weather portfolio allocates 55% to U.S. bonds. U.S. stocks. These provide the potential for growth. While they can be volatile, they have historically returned value over the long term. Dalio's approach suggests a 30% allocation to U.S. stocks. Gold. This precious metal acts as an inflation hedge and a diversifier. Its value can increase when confidence in paper money diminishes. It forms 7.5% of the Dalio all-weather portfolio. Commodities. These include oil, agriculture, and other raw materials. Commodities can be a good hedge against inflation and provide further diversification. In the aforementioned Dalio mix, they comprise 7.5%. Real estate. Physical assets like real estate can be a hedge against both inflation and deflation, growing in value during economic booms and retaining value in downturns. For instance, Harry Brown's permanent portfolio suggests a hefty 25% allocation for real estate. Cash equivalents. These are highly liquid assets like money market funds. They bring stability and can be strategically used to capitalize on market dips. You should consider utilizing cash as a piece of your portfolio, especially when the interest rate environment is most attractive. It's crucial to emphasize that while these allocations and asset types provide a guide, the ideal composition of an all-weather portfolio varies for each investor. Factors like an individual's financial goals, time horizon, and risk tolerance play pivotal roles. Therefore, working with a financial advisor can help tailor a portfolio that best suits one's unique circumstances. Constructing an all-weather portfolio involves a systematic approach that factors in the investor's objectives, risk tolerance, and market conditions. Here's a structured breakdown of the process. Define investment goals. Begin by setting a clear and achievable investment objectives. Consider aspects like time horizon. Are you investing for a short-term goal or a long-term retirement plan? Desired return. What annual return are you aiming for? Risk tolerance. How much market fluctuation can you withstand without panicking? Choose asset classes. Depending on your goals, pick the asset classes that resonate with your objectives. Common choices include stocks for growth potential, bonds for income and stability, commodities, gold for diversification and inflation protection, real estate for tangible asset exposure and potential appreciation. Determine asset allocation. Assign a percentage of your portfolio to each asset class. This distribution should mirror your objectives, risk profile, and market analysis. For instance, a more risk-averse investor might lean more heavily on bonds or cash. Someone looking for growth and willing to tolerate volatility might opt for a greater allocation in stocks. Rebalance regularly. Market dynamics can drift your portfolio away from your desired allocation. Rebalance periodically to realign your investments with your strategy. This might mean selling some assets and buying others. Consider risk management strategies. Incorporate techniques to safeguard your portfolio against extreme market conditions. Hedging. Using financial instruments like options to offset potential losses. Tactical asset allocation, a dynamic approach where you adjust your allocation based on market forecasts or economic trends. Stay informed in adaptive markets, economies, and personal situations involved. Regularly review your goals and strategies, staying informed on global events and economic indicators. As mentioned, the Dalio all-weather portfolio is one example, allocating 55% to U.S. bonds, 30% to U.S. stocks, and 15% to hard assets, with 7.5% in gold and 7.5% in commodities. However, remember, this is just a template. The right allocation for an individual investor will hinge on their personal circumstances, goals, and risk tolerance. Always tailor your approach to fit your unique situation. Rebalancing a portfolio ensures that it stays aligned with the intended risk profile and investment objectives. Here's a concise summary of the best practices for rebalancing an all-weather portfolio. Set a schedule. Regularly review and rebalance your portfolio, whether annually, semi-annually, or quarterly. Rebalancing depends on individual preferences and market dynamics. Maintain original asset allocation. The essence of rebalancing is to stick to the initial asset mix. When some assets outperform, they become a larger portion of the portfolio, hence the need to sell these securities and buy those that have underperformed to get back to the intended allocation. Mind the tax implications. Every time you sell assets, especially at a profit, you might incur capital gains taxes. Always factor in these implications, and where in doubt, consult a tax professional. Watch transaction costs. Frequent rebalancing, while it might seem strategic, can lead to increased transaction costs. Be cognizant of brokerage fees, spreads, and other charges which can eat into your returns. Stay aware of market conditions. While maintaining your intended asset allocation is paramount, it's also wise to be sensitive to prevailing market conditions. There might be times when strategic deviations are warranted. Engage a financial advisor. Managing and rebalancing a diversified portfolio can be intricate. A seasoned financial advisor can offer guidance, ensuring your strategy remains optimal and true to your investment goals. In essence, while the concept of rebalancing seems straightforward, selling high and buying low, it involves a meticulous blend of strategy, timing, and awareness of broader market and economic trends. Staying disciplined and adhering to these best practices can help you navigate various market terrains while keeping your investment objectives in sight. Let's delve into the concept of expected returns for an all-weather portfolio. An all-weather portfolio's primary goal is to deliver consistent positive returns across various economic environments and reduce exposure to market volatilities. While it's structured to provide steadiness, the exact returns can be influenced by multiple factors. Asset allocation. The portfolio's composition, how much is in stocks, bonds, commodities, etc., will significantly impact its performance. Different asset classes have varying risk and return profiles. Market conditions. Economic factors like interest rates, inflation, geopolitical events, and market sentiments can influence the returns of assets within the portfolio. Time horizon. Over short periods, the portfolio might experience fluctuations. However, an all-weather strategy is designed for the long term, where it seeks to smooth out temporary market volatilities and deliver consistent returns. Fees and costs. The net returns can be influenced by the costs associated with managing the portfolio, such as transaction fees, fund management fees, and other related costs. Active versus passive management. Whether the portfolio is actively managed with frequent buying and selling decisions based on market analysis or passively managed like an index fund, it can also influence its returns. As highlighted, the Dalio all-weather portfolio, a popular all-weather strategy, aims for an average annual return in the ballpark of 5 to 6%. Yet, it's crucial to recognize that past performance isn't a guaranteed indicator of future results. Market dynamics change, and what worked in one decade might need adjustments in another. To determine or adjust an all-weather portfolio's expected returns, always factor in personal financial objectives and risk appetite. Given the intricacies involved, it's advisable to collaborate with a financial advisor. Let's explore these popular exchange-traded funds that can be incorporated into an all-weather portfolio. The Vanguard Total Stock Market ETF, VTI. It represents a broad spectrum of the U.S. stock market, capturing a mix of small, mid, and large-cap stocks across various industries. It offers diversified exposure to the equity segment of an all-weather portfolio. iShares Core U.S. Aggregate Bond Index. AGG, a comprehensive bond market ETF. AG includes a wide array of investment-grade U.S. bonds. This can serve as a foundation of the fixed income component of a portfolio, offering balance, especially during equity downturns. SPDR Gold Shares ETF, GLD. Directly linked to the performance of gold, GLD acts as an inflation hedge and a diversifier, especially valuable during periods of heightened market uncertainty and currency devaluation. Invesco Optimum Yield Diversified Commodity Strategy No K1 ETF, PBDC, provides diversified exposure in the world of commodities without the complexities of K1 tax forms. With holdings spanning energy, agriculture, and metals, it's a handy tool to hedge against inflationary pressures. Vanguard Long-Term Treasury ETF, VGLT, offers exposure to U.S. Treasury bonds with longer maturities. Often seen as a safe haven, long-term treasuries can be a counterbalance in the volatility of riskier assets in the portfolio. Vanguard Real Estate ETF, VNQ. This ETF offers exposure to the U.S. real estate sector, specifically real estate investment trusts, or REITs. REITs are companies that own or finance income-producing real estate across a range of property sectors. Investing in VNQ provides a method to gain diversified exposure into real estate, benefiting from the income and long-term growth potential properties can offer without having to buy the actual properties. Given real estate's low correlation with stocks and bonds, it acts as a valuable diversification tool. When considering these ETFs for an all-weather portfolio, it's essential to allocate according to one's goals, risk tolerance, and investment horizon. As with any investment strategy, periodic reviews and possible rebalancing are essential to ensure alignment with desired outcomes. Consulting a financial advisor can provide a deeper understanding and personalized guidance on integrating these ETFs into a cohesive investment strategy. Thanks for listening to Wythdrawl Investing Insights. We hope you had learned a thing or two. Please like and subscribe.